So welcome to today's presentation. My name is Peter Yosef, Senior Market Analyst at IronFX. We're going to be mixing technicals with fundamentals today. And we make a start with EURUSD. In front of your screens, you have EURUSDs for our chart. All charts to be presented are to be of the same time frame, unless otherwise stated. Now we highlight here on a technical level, first of all, two elements. The first is the fact that EURUSD was on the rise yesterday, and that was partially or mainly a USD weakness. We saw the US dollar yesterday weakening across the board. While on the other hand, we have to note here that the euro was able to benefit the most out of this weakening of the US dollar. So practically the 1.0635 has been broken, and that has to be switched into support line in green. Let's go hunting for a new ultimate resistance line. Let's add also some toolbars. Let's unlock the chart, go back. And we have a nice peak right here. Note how this level was tested once, twice, and aimed for here. Pretty valid. I'm keeping that. And that would be in red, the 1.0930. Locking it in, readjusting the chart. Let's correct also the labels and reposition everything. Here we are. So starting with the S3, which is now being placed at 1.0315, the S2 at 1.0460, the S1 used to be a resistance line, now turned to support, the 1.0635, the R1 being set now at 1.770, the R2 at 1.0935, and the R3 at 1.1095. The second element, we have mentioned already the rise of EURUSD yesterday. The second element which we would like to mention was the drop of the pair during today's European session. Now, we had some financial releases which tended to weaken the euro side of the pair, and we're talking about Germany's GfK consumer sentiment, which came in lower than expected, deeper into the negatives, implying a wider pessimism on behalf of the average German consumer, something which may slow down retail sales in the largest economy of the Eurozone. However, the second element, which was quite worrying, were the preliminary PMI figures for October and specifically Germany's. Now, there was a slight improvement in Germany's manufacturing sector PMI figure. The worrying part, though, was that the figure was still deep below the reading of 50, implying another contraction of economic activity for the sector. But I would also highlight here the fact or if you prefer, the drop of the services PMI figure, which tended to highlight more or less that the contraction was practically across the board in the German economy, something which may more or less lead towards a recession should that be stabilized. And it's characteristic that if we drill into the minute chart, note the wide drop here. This one. Practically this wide drop here was instigated by the release of Germany's PMI figures, while this one was of France's. They weren't positive either. Overall, Eurozone's economic activity contracted, given that the Eurozone's composite PMI, preliminary PMI figure for October was below the reading of 50, implying once again a contraction of economic activity across borders and across sectors. So overall, the economic outlook of the Eurozone tends to darken, and that tended to weaken the euro. Now, for the time being, we tend to maintain a bullish outlook, and I would be noting that the upward trend line seems to have intensified, and we would require practically for the change of a bullish outlook for the pair to break below the S1 1.0635 and start aiming for the downward trend line, upward trend line, break that as well as the second one, and start aiming for the S2 1.0460. I think it would be more obvious if we drill into the 1 hour chart to see more detail about this movement. You can see how it has been dropping over the past 3 hours, yet the drop seems to be easing, and that may allow it to bounce on the S1 and start aiming for the R1. For a bullish outlook, though, we would require the pair to bounce actually on this one and start aiming for the R1, and we would require a higher peak than this one. Back to the 4 hour chart. Let's move now to cable. Cable, which was also on the rise, yet not to the same degree as the euro was. So there was some benefits for GBP USD, but the pound was not able to capitalize so much on USD's weakness. Also, we saw a disappointment by the release of the preliminary PMI figures. And I would be also noting some disappointment from the release of UK's employment data. Now, we had some mixed results. On the one hand, we had the unemployment rate for August ticking down, while the employment change figure was in the negatives, but it improved in relation to July's reading. The worrying part may have been the unemployment claimant count, which practically rose to 20K, and that was for September. So practically that was a premonition that layoffs lay ahead for the UK employment market, and that was a little bit worrying on behalf of the employment data. It would be interesting to note, though, the market reaction, drilling back to the minute chart once again, unlocking the chart. And let's have a look where it was. Here it is. You can see this red candlestick right here. That was at the moment the UK employment data were released. However, the market, despite being slightly bearish over the next couple of minutes, 7 minutes, about 6 or 7, you can see that the bulls regained their confidence and led practically the pound higher, or if you prefer, cable higher. and that was diminished practically at the release of, okay, this is Germany's. Let's have a look at the UK data. And here it was. You can see how this was leading, the release led practically to this downfall here. Back to the forward chart. Give me a sec. Here we are. So on a technical level, despite the RSI indicator rising substantially, it reached actually the reading of 50. It corrected lower later on. It's now at 63, implying that the bullish sentiment which was built up seems to be fading away somewhat. And given the fact that the pair was unable to break the upper boundary of the current sideways motion, namely the R1, 1.2325, we tend to maintain our bias for the sideways motion to be maintained in the corridor between the R1 and the S1. It's highlighted in red, in yellow, and allow me to add another rectangle, which would be actually showing a possible continuation. There you go. So we would expect the sideways motion to be maintained for now. Should the bulls take over for bullish outlook, we would require A, the price action to break above the R1, 1.2325, and that has to be cleared. 2, maybe even the R1 providing some support once it has been broken. And 3, the price action to start aiming for the 1.25. On the other hand, should the bears take over, we may see cable breaking the S1 1.2065 and start aiming for the S2 1.1925. However, I have to note here that there's quite a distance to cover, and that does not seem to be the case. Okay, let's have a look at USD/JPY, which was also quite interesting. Now we can see a correction lower of USD/JPY, practically in the American session yesterday, and a slight widening of the Bollinger Band, some bearish tendencies being built up. On the other hand, though, we note that despite the RSI indicator dropping, okay, it didn't reach, it was at around 30, and that tended to imply some bearish tendencies for the pair. It corrected quickly back higher, aiming for the reading of 50, implying that the bearish sentiment is fading away and the market remains in an undecisive mode. We tend to maintain here a view for the sideways motion to be maintained, and that would be also due to the result that the upward trend line, allow me to drill into the daily chart. Now the upward trend line, which was guiding the pair since around the end of March, seems to have been broken for now. Mind you that it has been broken in the past again, but for the time being it seems to imply some stabilization back to the forward chart, which in turn may allow USD/JPY to remain between the R1 and the S1. I would be noting here that there's still some bearish tendencies, maybe also due to the fact that BOJ is going to be proceeding with another bond buying operation, which was unscheduled, implying that the bank more or less defends the ultra loose monetary policy settings it has set. And that could weaken JPY somewhat. In case, though, for a bullish outlook, I would require a clear break of the 150 resistance line and the pair to start aiming for the 151.45. Mind you, and I'm highlighting this, market, I wouldn't say expectations, but there are a number of market participants which tend to view the R1, the 150 resistance line, as a possible market intervention cutoff point. So practically, should USD/JPY rise above 150, then we may see the chances of BOJ or the Japanese government intervening in the markets increasing substantially, and that may bring an abrupt movement lower for USD/JPY, as it will try to defend the yen. Once again, for the time being, we tend to maintain a bias for the sideways motion to continue, and the possible bearish outlook, however improbable that may be, it's still a possibility and should be covered. I would require the pair to break below the 148.87 support line and start aiming for the 147.40. Moving now to AUD/USD. AUD/USD remains in a sideways motion between practically the R1, the 0.64, and the S1. I would be noting here that practically, give me a sec. Okay. For the time being, I would be maintaining, despite the upward movement during the past 24 hours after bouncing on the S1 0.6285, which also served as a verification of the support line. I do note it, as I do note also the fact that the RSI indicator has risen above the reading of 50 and it's currently at 63, 61. So there is some bullish tendencies here for the pair. Yet for a bullish outlook, I would require a clear break of the R1 0.64 and the pair to start aiming for the 0.6510. Practically, the pair has to escape the boundaries of its current sideways motion and start aiming for the R2 on a sustainable way, not something like this here. I would be noting on the monetary front that RBA Governor Michelle Bullock practically ruled out linking any rate hikes on behalf of RBA to the Australian employment market. So practically the bank is primarily being navigated by the path of the CPI rates. And I'm highlighting here, tomorrow we get Australia's CPI rates for Q3. The rate is expected to slow down, I think from 6% year on year to 5.3% year on year. Should that be the case, I would expect the pressure on RBA for another rate hike to ease further, which more or less may weaken the AUSSIE. And that would be an element which I would be keeping an eye out during tomorrow's Asian session. Now, for bearish outlook, we would require the pair to break the S1 0.6285, which, mind you, as we have noted, provided support yesterday. Here it is, in the early Asian session, but also provided support second, third time. So it's a pretty valid level. Should that be broken, then the next possible target for the bears is currently the 0.6165. For the time being, we definitely see that as a remote scenario and tend to maintain our bias for a sideways motion to be maintained. Let's have a look at USD CAD. USD CAD edged lower, and the question is whether we're dealing here with a slight downward trend line or not. For the time being, we definitely have to switch the role of the 1.37 from a support line to resistance line. And I would be noting here that practically the price action of the pair tends to remain in a sideways motion, still rotating around the S1. Now allow me to set the new ultimate support line. I'm finding this true here, but it could be a little bit higher like here. So it gets this one as well. Nevertheless, I'm taking the spike. And That would be the 1.3380. In red. Sorry, in green. Let's correct also. First of all, let's widen it a little bit. Here you go, that's better. Let's reposition the labels. Starting with the 1.35 support level, which is now being set at 1.36 S3, the S2 at 1.37. Sorry, my mistake. The S3 is now being placed at 1.3380. The S2 at 1.35. The S1 at 1.36. The R1 at 1.37. The R2 at 1.3785. And the R3 at 1.3885. Locking it in. The fact that the price action has broken the upward trend line we had drawn and at the same time remained close by to the reading of 1.37, below it but still close by, tends to lead us towards a sideways motion bias, and that's being also supported by the fact that the RSI indicator tends to remain close to the reading of 50, more or less showcasing a rather indecisive market about the pair's next leg direction. Should the bulls take over, I wouldn't be surprised to see the price action breaking above the 1.37 and start aiming, if not even breaching, the 1.3785, while a possible bearish outlook may lead the pair towards or even below the 1.36 support line. I would be noting here that CAD traders, okay, definitely on the one hand, may be watching oil prices which edged lower yesterday. But I think the focus is increasingly on BOC's interest rate decision tomorrow and not so much on the rate as such, but on the accompanying statement. We'll have time to discuss that more extensively tomorrow anyway. For the time being, once again, we tend to maintain a bias for a sideways motion to continue, and most probably the price action is to continue to revolve around the 1.37 resistance line. At this point, this can be deleted and this can be extended. It's going to be interesting to see whether the price action is going to be breaking above the 1.37 and start aiming for breaching the 1.3785, or whether it's going to continue to revolve around the 1.37. Okay, let's move out of the FX market and let's have a look at US stock markets. I would make a start here with NASDAQ. This is the daily chart. It's a quite interesting chart, and the reason why, see this green candlestick here? Note how that has broken the downward motion of the index over the past 1, 2, 3, 4 days. There was a stabilization yesterday, and today it's above it. And that tends to highlight the possibility of the downward motion being interrupted. Let's drill into the 1-hour chart for more details. And definitely we have to correct this. There you go. It has broken below the 14,790, which has to be placed in red now. 15,225 remains, and 15,575 remains as well. Back to the forward chart. Okay. Let's go hunting for a new ultimate support line. Let's go further back. I'm placing one support here. It's pretty wide as well, but seems pretty valid in my opinion. And that would be the 13,770. Green. Let's add also some labels. Starting with the R3 at 15,575. Could go a tad bit lower. Give me a sec to recheck that. No, it could not. You can see how it provided resistance here. So that's pretty valid as well. Moving to the next, the R2, which would be the 15,225. Moving now to the R1 at 14,790. Moving to the first support line. $14,435 in green. Could go down to 30 maybe. Yep. And let's check also the validity of the second resistance line, support line. It's at 14,085. However, I would like to see where that rests actually. Okay. Back to the daily. 1 hour. Daily. So it's in pretty old former resistance line now turned to support. Okay. Back to the forward chart. Labeling it at 14,485. S3 at 13,770. That's it. So for the time being, and given that the price action was able to break the downward trend line guiding it for the past week, we tend to switch our bearish outlook in favor of a sideways movement bias. And we note to that end practically the stabilization of the index over the past, actually since yesterday's session after the rise, while at the same time the RSI indicator has reached, actually it's nearing, it hasn't reached just yet, the reading of 50. It's currently at 45. Let's have a look. 46, which more or less tends to imply a more indecisive market. For a bullish outlook, I would require the index to break above the R1 14,790 and start aiming for the 15,525. On the other hand, should the bears regain control over the index, I would expect it to break below the S1 14,430 and start aiming for the S2 14,085. Mind you, on a fundamental level, we have a number of issues. However, I would be highlighting the earnings releases as the main issue, which may move, or more, if you prefer, may intensify market reactions on NASDAQ. And the reason why is we have a number of high-profile, high-tech companies, mega-cap companies, which are to release earnings reports. We start with Alphabet, Google's Alphabet today, and Microsoft as well. Tomorrow we have eBay. I would be noting also Meta. And on Thursday, I would be noting Amazon. So we have a number of high-profile, high-tech companies which are to release earnings reports. Should the earnings report show that these companies more or less did better than what the market expected, that may imply that the tech sector in the US remains rather healthy and could provide support for the index as a whole. While on the flip side, should the earnings reports not be as good as expected, we may see the issue weighing on NASDAQ as a whole. It's going to be a very, very interesting issue. Once again, we intend to keep our attention on this index practically for the next 48, maybe 72 hours. Let's have a look at oil, which had also a surprise move. Here you are. We note how oil prices dropped. That was yesterday, breaking the upward trend line, guiding it, breaking also the 87 support line. The question here which arises is whether there has been a new downward trend line guiding the commodities price lower. Definitely the 87 has to be turned into a resistance line. Let's go hunting for a new ultimate support level. And I would be noting this one. Could go this one even better. It gets to the upside, to the downside, again here. Seems pretty valid. In green, we're talking about 80? No, too high. 79.70. Yep. Readjusting. Could go even a little bit lower. Let's have a look. There's a nice show here. And even wider here. I think here's the best. It's a little bit off, I know it. And that's the 77.5. But symmetry is not my main point here. And to tell you the truth, I'm going all the way. Readjusting it. Let's correct the labels as well. The RSI indicator is between the readings of 50 and 30. implying more or less a bearish sentiment building up, yet it has stabilized just there. And the big question here is whether the bearish movement is going to be continuing or whether the price action of WTI is going to be stabilizing or not. And at this point, I would be highlighting another element, and that would be the fundamentals. It seems that, in my opinion, fundamentals for the bulls are still there, in the following sense that should there be any escalation of the crisis, of the conflict in Israel, that could provide substantial support for oil prices, given the market worries for a tight supply side. While I would be noting here that also oil traders may keep an eye out for the release of the US AP crude oil inventories figure later tonight, while tomorrow we get the EIA crude oil inventories figure. Should there be another drawdown, substantial drawdown of oil inventories, we may see oil prices gaining some support, while should there be a surplus and increase of inventories, we may see oil prices weakening. So that should sum it up from all of us here at IronFX. Best wishes for solid trading.
Hello, my name is Christina. When you're about to begin trading, the best thing to do is start small. Choose only a couple of trading instruments. Familiarize yourself with their past price action and make sure that you perform technical analysis on multiple time frames. Also, familiarize yourself with their fundamentals. For example, if you're about to trade Amazon, have a good look at what the latest developments are for the company, but also what events lay ahead that could affect the share's price. Your aim is to eliminate the surprise factor as much as you can. You don't have to risk a high amount. Keep the risk minimized by investing low, and initially don't forget to set up a stop-loss order and profit-taking level. Your aim should be to learn and familiarize yourself with trading, but at the same time to preserve or even increase your capital. Thank you for watching.
So, hi everyone, welcome to our Trade Management Series webinar. So, this is brought to you by Everest Fortune Group in collaboration with IronFX. So, today's first part of our series will be on scalping. Okay, before we get started, just a risk warning. Okay, Michael is a scalper most of the time. That's cool. I do like scalping as well. If I don't have that much time to sit in front of the computer, I think it's a good strategy as well. So we'll go through three powerful scalping strategies at the end of the webinar. So you guys can keep a lookout for that. Okay, so a risk warning, our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. So disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so here's our agenda. We'll just do a brief intro to scalping for those of you guys who aren't familiar with it. And then we'll take a look at Fibonacci confluence and where you should place your stop loss and take profit. And then stay tuned to the end to where we'll go through three powerful scalping strategies. So I'm your host for today. I'm Melanie. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay. And if you guys were curious, you can feel free to connect with me on LinkedIn as well. It's just my name. Okay. So what is scalping? So it's a fast-paced, exciting, and mind-rattling all at once. So basically, it's where you take trades for short time periods. So you grab very small amount of pips and you risk very small amount of pips as well. So you're basically taking advantage of market volatility in this case. And the time frame, if you guys were wondering, for scalping is normally on the shorter side, just so that you can catch all of the market volatility, the market movements. So it's briefly, we think that 1 minute to 5 minutes is a little bit too short. So because the time frame is so small, it can get really, your charts can get really noisy, and it might be a little bit difficult to catch all of the movements and conduct your analysis because of the constant movements. So we like to stick with 15 minutes to about 1 hour for scalping. Okay, so why scalp? There are known unknowns. Okay, so what we mean by this is a good example would be if the NFP is coming out tomorrow, for example. You know that the event is coming, but the outcome is unknown. So these events can really mess up a trade. So in this case, you would use scalping so that you can avoid any um, any known unknowns, basically. Okay, and locus of control. So let's use weather forecast, for example. So if there's a 1 hour forecast versus a 1 week forecast, you are likely to have more control over what's happening in the next 1 hour versus over the next 1 week. And new opportunities every time you open the chart. So market moves really fast on the M30 and H1. So there are new patterns every couple of hours. Okay, so how much time do you need to scalp? Time commitment wise, you basically have to find the trade and set the trade management. We'll talk a little bit about stop loss techniques and stuff like that later on. But that's basically all you need to do. Set the trade, make sure that your risk management strategies are intact, and that's it, you're done. And then you just have to review it every few hours. So the holding time is typically from a few seconds to a few hours, depending on your own strategy. So our recommended time to trade, or rather the different amounts of time that you have to put in, will be 1 hour in the morning, an hour in the afternoon, and an hour in the evening. So it's not too time consuming, and it's important to have proper risk management so that you don't need to monitor the trades all the way. Okay, so this talks about your trading stop loss, the different stop loss techniques, which we will briefly talk about later on in our slides. How much leverage do you need to scalp? So this is typically quite a high leverage strategy. So it's about 1 to 100 onwards. And you normally would use low spread pairs. How much capital do you need to scalp? So a good amount to start with is 250. That's just our recommended amount. Of course, it's completely up to you. Decent leverage of at least 1 to 100 is preferred, but not necessary. So if we're talking about what exactly is leverage, so if we take, for example, a trader who deposits $1,000, so they can use $100,000 with a 100 to 1 leverage in the market. So this can greatly magnify your returns, but also your losses. And this is considered acceptable as long as only 1% or less of the trader's capital is risked on each trade. So what this means is that with an account size of maybe $1,000, right? Only $10, or which is 1% of 1,000, should be risked on each trade. So while this is difficult in practice, traders should avoid the temptation of trying to turn their 1,000 into 2,000 quickly. Okay, so yeah, so if you can do it with $250, then you can do it with 2,500 and 25,000. But definitely don't rush into scaling up. Okay, now let's get into the 3 powerful scalping strategies first. Okay, so firstly, we have the horizontal pullback strategy. So if you guys were here for our recent support and resistance series on our webinars, yeah, this would be familiar with you. Next would be our Fibonacci retracement strategy. So it's pretty straightforward. You're basically using Fibonacci retracement to see where prices will retrace towards. And lastly, we have the Nike tick strategy, or what we call Fibonacci extensions. So let's get into these now. Okay, we're going to start with horizontal pullback strategy. So a horizontal pullback basically means that we are expecting price to pull back or retrace back to that level. So in this example, we see that we have a multiple swing high resistance, this red area. Okay, we have 3 swing highs that all line up along the same area. And then price surpasses this resistance. So it breaks out of it. And since it's breaking out of it, we are expecting price to return back to that level. If you're wondering why we can expect price to return to this level, it's because of this multiple swing high resistance. So basically, the more number of swing highs or swing lows, if we're talking about support, if we have more levels that more swings that line up in the same area, price is likely to return and respect that area again. Okay? So in this case, since it's a resistance at first, we are now expecting it to become a support. So from from a resistance. Once price surpasses it, now we call this a pullback support level. Okay, if we are looking at a multiple swing low support, same thing when price breaks past the support level, we're expecting price to retrace back to that same level. Okay, in this case, we are calling it a resistance. Okay, let me know in the chat if it's a little bit confusing. Okay, but here's a couple more examples. So the key basically to scalping is making sure that you have a bunch of indicators and a bunch of graphical analysis that all supports your analysis. So if in this case we have price moving below the Ichimoku cloud, so that's a bearish signal. Okay, and price has also broken out of this swing low support. Okay, so we're expecting it to return back to that level. And you can see that's exactly what it did here. Okay. Next, let's talk about the Fibonacci retracement strategy. So these are, firstly, this is an example of an insignificant swing. So just a reminder that these swings should not be used as Fibonacci points. Okay, because the swing highs and the swing lows are too insignificant. Instead, this is what you should be looking for. Really clear troughs and peaks and very clear market movement. So this forms the basis of all starting, middle, and ending points when we're using Fibonacci levels. Okay, so you shouldn't pick swing highs and those that are not significant, meaning that they need to have a relatively big move before or after it. So as a rule of thumb, you can use at least 15 bars before or after to see if they are really significant swings or not. Okay. Another reminder, okay, when you're drawing Fibonacci retracements, projections, extensions, or expansions, whichever you are doing, there's one important rule that you have to follow, and it's that your Fibonacci line must follow price structure. So your trend line can deviate from structure, but not by too much. So if you look at this example here, you can see that price doesn't really follow price structure over here. Okay, so this is what we've drawn is the shape of the price, and our Fibonacci just cuts through the shape entirely. So the trend line deviates from price structure by too much in this case. Okay. Next is our strategy. So the tool we're using here is Fibonacci retracement, which you can get from, it's the same tool that's on TradingView as well as MT4. So Fibonacci retracement percentage, excuse me. So for the percentages that we use for retracement, we use Mineta 5. So it's 23.6, 38.2, 50%, 61.8, as well as 78.6. So those are the levels that we use for Fibonacci retracement. Okay, so let's do a bit of a recap first. When you're picking the starting point, so basically your entry or your support or resistance levels, there are some rules that you have to follow. Firstly, we want to check if there's a swing high or low, pullback, or overlap level. So we talked about pullback already. Overlap, if you weren't here for our support and resistance, overlap basically means that there is a swing low as well as a swing high that are at the same level. Okay, that's what we call an overlap. So secondly, we want to make sure that our starting point goes back as far as possible. And you want to make sure that it doesn't intersect too many bodies of candlesticks, but the wicks are fine. So you see in this case, it's just the wicks, so it's an okay thumb. But we are preferably looking for really significant swings like over here. Okay, another example here. We're cutting too many bodies of candlesticks over here, which is why it's not preferred. If you look at the green thumbs, we have really nice multiple swing highs that line up nicely, as well as overlap levels once the swing low touches that same level. Okay, and we see here as well another swing high here. Okay, once again, cutting too many bodies of candlesticks over here, which is what we want to avoid. So in this case, in order to rectify the situation, you can actually just stop your support level over here. So it's a support level because price has already surpassed this resistance, thus making it a pullback support because we're expecting price to pull back or retrace back to this level. Okay, so we talked about the pullback already, so I'm just gonna really quickly skim through this. I'm just gonna show you guys the GIFs. Yeah, and show you guys how we look for pullback support and resistance levels. Okay, so here we are making use of two levels, or rather two Fibonacci trend lines. Okay, we have this really long one here and one small one here. And then we highlighted the area where we are expecting price to retrace off of. Okay, so the 61.8 and the 38.2 that we see here lines up nicely with this swing low. Okay, so a pro tip is that when a pullback support level lines up with a Fibonacci level, in this case we have two Fibonacci levels, so it's a very powerful level. Okay, because for this webinar we are focusing more on scalping strategies, so the time frames that we're looking at are on the shorter side. So briefly from 15 is like the lowest that we go, 15 to about 1 hour, preferably 30 to 1 hour for scalping. But this strategy can be used for pretty much anything, even if you are a day trader as well. Okay, but yeah, for this webinar, mainly focusing on the shorter time frames. Okay, we looked at these examples earlier. No worries, friend. So we have another example here, the pullback resistance as well. So you can see that we have a significant swing low here, right? And price has surpassed this level. So once price has surpassed it, it then becomes a resistance because we're expecting price to pull back to this level. And you can see that's exactly what it did. If we move on to overlap. So I already briefly mentioned it earlier, but yeah, this GIF basically tells you what an overlap is. It's when there are bulls and bears that are respecting that area, which is why it's an important point to take note of. Similarly, if overlap areas line up with other elements like Fibonacci or graphical elements, then it'll make it even stronger. Okay. Here's another example. I think you guys have kind of gotten it by now, but just another example in case you weren't clear. So this is a pullback resistance first, okay, because price has surpassed the swing low level. So it's surpassed it, we're expecting price to pull back to it, and once price pulls back to it, as we see in this GIF, and reverses off of it, it then becomes an overlap level instead. So the difference is that the difference between pullback and overlap is that once price reverses off of the level, then it becomes an overlap level. Whereas for pullback, we're just looking for price to surpass it. Okay, so now that we know what overlap and pullback levels are, we can combine them to find strong resistance and support levels. So, sorry about the text, but here we have a big swing high resistance level. Okay, price surpasses this level and becomes a pullback support. So we expect price to pull back or retrace to this level, the same rate level here. Okay, and in the green arrows, we see price retrace this level and bounce off of it perfectly. Once price bounces off the pullback support, it then becomes an overlap support level. Okay. Combination of pullback and overlap. Same concept over here. We have two swing high resistance and then a pullback support once price surpasses it. And then we can see price actually respected the area twice in this case. And then once price bounces off of it, it then becomes an overlap support. So actually, even after the first bounce off of this level, it's already an overlap support. Okay, but yeah, we normally when it happens once, you can expect it to happen again. Okay, another example here. In this case, we have prices respecting this 33420 level many times. Okay, with swing low supports, then a pullback resistance, and then you pull back to our resistance 3 times, and then a pullback support, and then back to our support level. Okay. Here's another example. Okay, we have this double swing low support. Price breaks out of it. Okay, we're expecting price to retrace back, but we also have a Fibonacci retracement. You see here 61.8 that lines up with that same level. We also have this 100%, this bigger Fibonacci level here with a 50% Fibonacci level that lines up with the same area. Okay, so this makes it a confluence area, which basically means that you have multiple Fibonacci levels that line up with the same area. Okay, so the reason why that's important is because price is always more likely to be attracted to these areas of confluence. And you can see over here that price was attracted to this area, okay? And then we're expecting it to bounce off again. Okay, like we see over here. Okay, so like I mentioned earlier, we typically want to try and use graphical techniques, indicators, different kinds of indicators basically to support your analysis. Okay, here we see that we might have a descending trend line, but you guys know that a valid descending trend line, you need 3 significant touches because 2 is quite common, okay? But we have price moving below the Ichimoku cloud, okay, but it looks like it's breaking out. We also have this almost descending trend line here. Okay, and we also have a Fibonacci retracement where 38.2 lines up with our trend line over here. Okay, And we're also making use of stochastic in this case, where we see that we have 3 swing highs that all line up together. So what this is called is a hidden resistance level. Okay, which basically tells us that price is likely to drop again, like we see over here. Okay, we see it happen twice. Price is making a lower high. Okay, but then over here on our stochastic, it's the same resistance level. So we can expect it to happen here as well. Okay, any questions about this? Okay, all good, let's move on. So this is our third strategy, which is the Nike tick strategy. So it also makes use of the Fibonacci retracement tool. Okay, but instead we are using the levels that are more than 100%. So not included here is the 161.8 level as well. So we use 127.2, but we also use 161.8. And this is basically how you use it. Okay, so you have a starting point and an ending point, which is where you draw your Fibonacci trend line. Okay, and the shape that we're looking out for is basically like a Nike tick. So you have you want to make sure that the tail of your tick surpasses 100% of the starting point. Okay. Yeah, and then you see you're projecting where price will reverse off of. So in this case, price reverse off of the 161.8, and then we expected a reversal here. Maybe I'll just show you guys like where you guys can find this on our website. Okay, so you can find it over here. This is just the forexarmy.com. Maybe I'll just pop it into the chat. The Okay, so we have a bunch of trading guides and tools as well. So the tools are mainly for MT4. Just a bunch of indicators, free indicators for you guys to download. Okay. Yeah, support resistance guide and how to draw Fibonacci retracement correctly. So if after this you are still a little bit confused, you can go ahead and look at the extensions. So the extensions is basically what I'm referring to now, the Nike ticks. Okay. Retracements are really basic Fibonacci levels that are important as well to know how to use. Okay, so we have the clear market structures. You can see what to look out for. Yeah, you can go and explore this on your own along with the different confluence areas. Okay, and we'll talk a little bit about this towards the end of our webinar today as well. But yeah, if after this you're a little confused, you can go ahead and check the Forex Army out. Okay, so another example here of a Fibonacci extension. Here it's pretty small. Okay, we have a really small tick here. So you can see the hit from the 100% to the 0%. That's where I've drawn the trend line. Okay, so I've drawn the trend line and then I'm projecting where it goes. So I see that firstly, I have a swing high resistance here. Okay, so this is where I'm projecting price to go towards, but I see that it's also in line with a 127.2% Fibonacci extension. Okay, so it makes it a significant level. like you can see over here. Hi, Azif. Okay. Yeah, so this is the shape that you want to be looking for basically, with the head of the tick like this. And you can only use this technique once price has surpassed more than 100%. Okay, but the shape is like a Nike tick. In this case, I'm showing you guys an example of an inverted Nike tick. So the shape that we're looking for, same thing, we're looking for the head to be shorter than the tail. So the tail has to surpass 100%. Same idea, completely the same. It's just that it's upside down. Okay. In this case, we see that price has surpassed the 127.2%. Okay, so we are expecting price, or rather we're projecting where price will go towards. And in this case, we have price, we have a swing low support that lines up with the 161.8% Fibonacci extension. And you can see that price is reversing off of this level. Okay, so here's how it works, or what we are looking out for when we are using this technique or this strategy. Okay, so we're watching for the reactions off of the 127.2 and 161.8. We're expecting it to reverse off. That's basically what we are doing with this strategy. Okay, notice how we only go in with the Fibonacci extension after price breaks out of the 100% level. Okay, let's move on. So here's another example of the Nike tick strategy. So the time frames that we recommend for this are 30 minutes, 1 hour, and 4 hours. The entry criteria is that once price breaks out of the 127.2%, stop loss level, okay, these are just recommended areas. So you don't have to follow these closely because charts are completely different. Okay, I don't think you guys can find a chart that looks exactly like this over here. So these are just our recommended areas for you to reference. Okay, so our idea in validation level is the 138.2. Break even is 11% of the recent move. 50% take profit is also 11% of the recent move. Full take profit, 22% of the recent move. And then for bonus, we will go in with other Fibonacci techniques like retracement, expansion, projection, and also support and resistance, like we previously mentioned. You're going with your pullback as well as your overlap levels. Okay? So this really just for your reference, okay, it's not like you really have to stick to these levels. It's just if you're starting out and you don't know where to place your levels, you can just follow this guide. Okay, so here is the long example. Here we have two Fibonacci techniques that we're using. Okay, firstly, it's a little bit hard to see, but we are firstly using a Nike tick. Okay, let me show you guys where the Nike tick is from here to here. Okay, and then we see price surpass the 100%. And then we see the 127.2%, or it looks like price is approaching it here. Okay, and then we go in with our projection. So our projection is from here. Projection uses 3 points, okay? So the starting point here middle point here, and ending point here. Okay, and for projections, we use 3 levels, 61.8, 78.6, and 100%. So we see here that the 61.8 lines up with the 127.2 at this level here. Okay, so we can see that price reacted off of it nicely and shot back up. Okay, maybe another technique that I just want to briefly mention is our Fibonacci expansion. So for expansions, we use, let me try and find it. We use the negative levels. Okay, we use the negative levels, minus 27.2 and minus 61.8. So for this, we look for the flash kind of shape like you can see here. And we can often use this Fibonacci expansion with your projection levels. So like I mentioned, the 3 points. The 3 points is your projection, and we normally can use that with the negative levels. So you can see here the negative levels, we have minus 27.2 and minus 61.8. And you can see how price reacted off of the minus 61.8 really nicely. Okay, now we're going to talk a bit about trade management with Confluence. Okay, so a good habit is to place your stop loss beyond a key Fibonacci confluence area. And the reason for this is because more often than not, price is attracted to areas of Fibonacci confluence, like we mentioned earlier. So if your stop loss is right before it instead of beyond it, you will likely get stopped out before the market reverses. Okay, so this is one of the reasons why people wonder why they get stopped right out before market starts to reverse, and then they start to complain about stop hunting. Take profit, on the other hand, you want to place it before a major confluence area. So when price reaches the Fibonacci confluence area, there's a high chance that it won't be able to go beyond it because obviously we're expecting it to reverse. So instead of it reaching your profit target, it's likely to reverse back to your entry instead, or maybe even to your stop loss. Okay, so and then people will complain that the market is being manipulated because they missed their take profit by 1 pip. So here's an example of how you can place your stop loss and take profit, just to maximize your wins and minimize your losses. This is also on the forexarmy.com website, so you can go ahead and take a look after this webinar. Okay, Fibonacci confluence. So multiple Fibonacci retracement lines up together, so we know that this is what makes a proper Fibonacci confluence, and the example is over here. Okay, we have minus 27% Fibonacci expansion, as well as the 161.8 Fibonacci extension that all line up nicely here. Okay, so maybe just to break it down for you guys, the minus 27% Fibonacci expansion, we're looking for flash or lightning bolt kind of shape. So you can see that over here. Fibonacci projection, similarly, we are also looking for a flash shape. That's why I said these two can likely be used together normally. Okay, so you can also see it, see the lightning bolt shape. And then the 161.8 Fibonacci extension, this is our Nike tick strategy. You can see that the Nike tick is inverted in this case. Okay. Yeah, and you can see price bounced off of this level. Another example here, we have the 127.2% Fibonacci extension, right? So this is the extension, and it lines up with the 61.8% Fibonacci projection. So the 3 points over here. Another example, 100% Fibonacci projection. So you can see the 3 points once again is your projection. I think you guys can see the lightning bolt shape here. And then we use a 127.2% Fibonacci extension. So you can see the Nike tick shape. So what we are looking for is basically levels that kind of look like this. So as long as you have two levels that line up nicely. Okay, so we're combining Fibonacci methods again. In this example, Fibonacci expansion. So you can see the lightning bolt shape here. And we have a minus 61.8% and the 161.8% Nike tick. So you can see the tick here. Okay, and we are projecting it to reverse off of this confluence area here. Okay, so we would expect it, or rather we would project it to reverse off of the higher area, obviously only when price breaks out of this level here, which is why it's good for scalping, because then you can take these small movements pretty easily. Okay, another example here. Okay, the minus 27.2% Fibonacci expansion. This is once again the lightning bolt shape. You can see it really clearly here in this case. And then the 100% Fibonacci projection, also lightning bolt shape. And then the 127.2% is the Nike tick shape. So you can see it. It's inverted in this case, okay? And all of these three levels line up and we see price reverse off of this area. So it's attracted to these areas, but it's not likely to go beyond it. So it'll be attracted to it, it'll test this level, and then it'll reverse off. That's the kind of movement that we're looking for here. Okay. If we look at dynamic take profit and stop loss placement, okay, your swing high would be your stop loss in this case because we're expecting price to hit towards our take profit. So we're going in for a sell in this case. Okay, so take profit is your swing low resistance here. Entry is at this swing low support that's turned into a pullback resistance level. Okay, and this level is also in line with the 78.6% Fibonacci retracement. So price hits our entry really nicely and reverses off of it and hits towards our take profit. Okay. Another example here. This is the same example, sorry. But in this case, I'm showing you guys that we have another Fibonacci retracement. No, this is a projection, sorry. So we have a projection here with a 78.6% that lines up nicely with our take profit. Okay. And then we see price just touched our take profit before reversing off of it. So this is why it's so important for you to know where to place your take profits and stop losses. Okay, because you can see here, it'll drop and then reverse off of it really quickly. So you have to be able to catch that touch before price reverses. And you can see it's really good that it touched nicely because it went straight to your stop loss after that. Another example here. Okay, we have price breaking out of the descending trend line. So since it's breaking out of it, it's giving us a bullish signal. And then we have this entry level we have our entry level here, which is a significant level. You can see the number of times that price has tested it. And then you can see that we have a lot of Fibonacci levels that line out nicely. Okay, we have the minus 27.2 Fibonacci expansion, 127.2 Fibonacci extension as well. Okay, and these all line up with this level here, which we then make our take profit. So if I had placed my take profit above the confluence area, price actually reached it and reversed off of it. So it would have missed my take profit by a few pips. And it would have hit it straight to my stop loss. Okay, whereas if I had placed my take profit below the confluence area, price hits our take profit nicely before reversing back down. Okay. Okay, that's it for my slides. Let me know if you guys have any questions. Maybe just to summarize, the three scalping strategies that we went through today, okay, were the Nike tick, which is the last one that we went through, and then the retracement as well as the pullback. So basically, you can use all three together, and that's the best strategy is to combine all and form a confluence area so that you know which areas to look out for, and of course, know where to place your take profit and stop loss levels as well. Okay? Once again, if you have any questions after this webinar, feel free to check out forexarmy.com. Most of the information is there. How do we access previous sessions? I'm not sure if it's on YouTube. I think you can check YouTube first, the IronFX YouTube. But if it's not there, you can email IronFX. Okay, thanks so much, Wayne. Hope you learned something from this. Yeah, if you guys don't have questions, feel free to leave the session. Have a great rest of your week, and I will see you guys next week for our our second part of this trade management series. And you can find me on LinkedIn if you want. Thanks, friend. See you guys next week. Bye, everyone. Thank you.